From 540 to homeowner. Daniel's credit recovery journey. Daniel Nguyen never imagined his credit score would become his biggest obstacle to finding a stable home for his family. After a series of health challenges 2 years earlier led to unexpected medical leaves and mounting bills, his previously excellent credit had plummeted to 540. Despite returning to his job as an IT specialist, with a solid income and his wife Lisa's stable position as a teacher, traditional mortgage lenders consistently declined their applications when they attempted to buy in the competitive Vaughan market. It was frustrating knowing we could afford the monthly payments, Daniel explained during his initial consultation. Our combined income was strong, we had some savings, but that credit score number was like a wall between us and home ownership. One lender actually told me to come back in 3 to 4 years once my credit had recovered. For many GTA residents with credit challenges, this advice to simply wait years for credit recovery feels increasingly impractical as housing prices continue rising and rental rates consume funds that could otherwise build equity. Daniel and Lisa calculated that waiting 4 years would likely mean purchasing a significantly smaller property or moving much farther from their workplaces and the children's schools. The traditional approach to bad credit is simply waiting it out, but in Toronto's market, time works against you as prices appreciate, explained the housing specialist who eventually helped the family. Rent-to-own programs view credit challenges differently, not as permanent disqualifications, but as temporary obstacles with specific recovery timelines. What Daniel discovered was that GTA rent-to-own programs typically evaluate credit situations using a matrix of factors rather than simple score thresholds. These include the cause of credit challenges, one-time events versus pattern behaviors, recovery trajectory, improving versus stagnant scores, time since major derogatory events, bankruptcies, consumer proposals, and collections, current income stability and debt-to-income ratios, payment history on current housing and utilities. Traditional lenders tend to use rigid credit score cutoffs, often requiring 650 plus for conventional mortgages. Rent-to-own programs instead look at recovery potential during the rental term, the specialist explained.
For someone like Daniel, with a clear recovery path and strong income, a structured 24, 36-month program can create a bridge to future mortgage qualification. The rent-to-own structure provided Daniel's family 3 key advantages specific to their credit situation. First, it established a precise credit recovery timeline with monthly monitoring and improvement strategies. Second, it secured their housing at current market prices rather than future appreciated values. Finally, it created documented payment history specific to housing that would strengthen their eventual mortgage application.
Their program included several credit-specific elements: quarterly credit monitoring and score improvement strategies, direct reporting of their rent-to-own payments to credit bureaus to build positive history, structured debt management for remaining medical collections, specific mortgage pre-qualification milestones at 12, 18, and 24 months, and relationships with alternative lenders who specialize in near-prime borrowers. Most people with credit challenges assume home ownership is years away, when structured programs can often create viable paths in much shorter timeframes, noted the credit specialist who advised Daniel and Lisa. The key is demonstrating that your challenges were situational rather than behavioral and showing clear recovery momentum. For the Nguyen family, the 30-month rent-to-own agreement for a semi-detached home in Vaughan provided immediate housing stability while creating a structured path to mortgage qualification. Their option fee, equivalent to approximately 3.5% of the purchase price, was slightly higher than programs for buyers with stronger credit, but substantially lower than the 20% down payment most traditional lenders would have required given their credit situation. 18 months into their program, Daniel's credit score had recovered to 643, with projections to reach 680 plus by their purchase date. The credit recovery happened more quickly than anticipated due to the structured approach and the removal of several collections accounts. Their mortgage broker was already identifying conventional lenders who would consider their application given their strong income, improved credit trajectory, and the equity they'd built through rent credits. What surprised me most was discovering that credit recovery can be strategically accelerated with the right approach. We were told to simply wait years, but our structured program helped us address specific credit issues while already living in our future home. For GTA residents wondering if home ownership is possible despite credit challenges, Daniel's journey illustrates that the answer depends not just on current scores, but on recovery trajectories, income stability, and utilizing programs specifically designed to bridge temporary credit situations. While not every credit scenario can be accommodated within rent-to-own structures, many families with moderate credit challenges and strong income fundamentals can find viable paths forward. Bad credit doesn't have to mean indefinite delay in today's market. With the right program and structure, it can mean a different path to the same destination, one that actually provides protection against further market appreciation while you recover.